Hello everybody, I hope you're all well. It's Friday, it's the 29th of October 2010 and I made a video last night and I was going to post it this morning, and then I got an email from somebody in the United States and they were quite concerned, and I responded to them already. They know who it is, so I don't need to tell you basically anything about it. It's just one of the people that I know. I just know this person in the United States. And they were a bit concerned. They're from the Philadelphia area, and they were telling me that, I don't know what part of Philadelphia, it's probably on the outskirts, but they were telling me that last weekend 2 banks closed in the area that they live in. One bank was quite near to them and another bank was about 80 miles away. And I was talking then to another chap that I speak to, and he was telling me that last week in total 13 banks closed in the United States, and from the beginning of the year 147 banks have closed in the United States. So I told the guy that I'd make an email, who sent me the email, that I'd make a video basically explaining what's going on, why it's happening and why it's going to continue to happen. And in order to do that, I've got to talk about an economic concept. Now, before I start all this, I don't want people telling me you were wrong, you didn't put the comma in there and you spelt that word wrong. Listen, I'm an ordinary man. I don't have a degree in economics, but I'm not a moron either. I'm not a fool, and I hate people treat me like I'm a fool. And 2.5 years ago, when all this blew up, this stuff all started, I made it my business to investigate it as best I possibly could over a good period. I got a reasonable grasp of it. I think I got a reasonable grasp of it. Not to, just an ordinary layman's grasp of it. It didn't take me too long. Alright? Any of the economists I've spoken to so far about it, they all sort of agree with what I've said. Alright? And I'm going to try and explain this. It's a small concept, but I just want you to understand it. Alright? Because it's at the back of what's happening with these American banks and why they're all closing. A lot of them anyway. Not all of them, of course, but a lot of them would be. So let me explain to you what happened here. This all started about 15 years ago in America, and it started because China and Japan, specifically the Far East, in particular Japan had a thing called a carry trade. And what it meant is that you could go to Japan and you could get money at a ridiculously low level, because they had had a property and an equity collapse like we are having in Ireland in 1981, and to offset it they decided that they'd reduced their interest rates way down. So they introduced legislation in their parliament building through their central bank, and they reduced their interest rate down to about 0.5%, and it was totally and utterly unprecedented. So from all over the world people came to borrow money in Japan, and of course big American investment banks got involved in it, and they borrowed the money and they in turn passed it out to mortgage companies. And the reason they did this was because they come up with a master plan, and the master plan was as follows. The master plan was based around what are called mortgage-backed securities. So you just remember, that's an umbrella concept for what I'm going to discuss, okay? And what these mortgage-backed securities were essentially was large groups of mortgages that were bundled together into what's called tranches, and then they were sliced up and sold all around the world. Okay? And the way this worked was very simple. They got the cheap money from the Far East, sucked that up, okay? They put it all together, fired it out into various mortgage companies who had the availability of the funds. Okay, they drew the funds down and they sold the mortgages to everybody and anybody. Their salesmen all earned good money. And of course what happened was, when the mortgage company got the mortgage and signed off on it, it was passed back to the investment bank. The mortgage company got paid for doing what they did, and the salesman got paid, and everybody was happy. So now what you had is, you had these big American investment banks who had initially got all this Chinese and Japanese money, and they had, instead of all this Chinese and Japanese money, they had all these bits of paper called mortgages. So they bundled thousands of them together. That's generally how it was done. 1,000 of them was the minimum tranche. And they made up these things called tranches. Now, some of these tranches contained 100,000 mortgages, but let's not go down because I'm going to complicate the thing. Let's just deal with a tranche that has 1,000 mortgages. Okay? And each of the mortgages costs $500,000. Let's just round it off and say $500,000. So we've got 500,000 multiplied by 1,000. That's $500 million. 500 million. Okay? And what happened was, as I say, they put them into a big tranche and they made them up into what's called, they sliced them up like the way you'd slice salami, and they made them up into what's called CDOs, collateralized debt obligations. And they sold these all around the world. They sold them to their clients, they sold them to investment funds, they sold them to hedge funds, they sold them to mostly a lot of pension funds, all right, and to other banks. Okay, smaller banks. How they were able to do this was fantastically. Well, for a start, they had all the wonderkins, you know, all the economic wonderkins. They drew up all the parameters for the CDOs. They drew them all up. And the idea for anybody who doesn't know anything about history, or for the idea for anybody who doesn't know anything about, really instinctively knows anything about economics, sounds like a brilliant idea. They were all based around property. Mortgages, property mortgages. And they worked off an incredible idea that the very last thing that people tend to default on are food and shelter. They have to have food and shelter. So the very last thing, they'll default on everything. They'll default on car loans, personal loans, everything, but they generally do not want to be thrown out of their house. So they'll do everything to pay their mortgage. That was one of the things that this thing was founded on. So it was a sort of a default of last resort, as it were. That was it. So the other thing was, because you had 1,000 of these and they're all sliced up, you didn't. The final person who got the CDO, he only owned a percentage of 1,000 mortgages. That's all he owned. So his risk was spread among the whole 1,000. But at its core, there was another assumption. And this assumption was totally fallacious. Totally and utterly incorrect. And this is what's causing all the problems today. And this assumption was what they sold the whole thing on. And that was that the property market would continue to rise. That the value of bricks and mortar and land would continue to go up. It had shown this wonderful curve and they said this is going to continue. People are in full employment. Everything's all wonderful. Of course it was all a load of balls. It's all a total load of balls. Because markets only do three things. Markets cannot do anything other than three things. They go up, they go down, or they stay stationary. That's all they do. All markets. Don't do anything else. And this market had risen over a period of about 20-25 years in the United States. And they were projecting it like they did in Ireland, and like with the equity market, that it would go on and on and on and on. And of course, that's a total nonsense. Because what happens is the smart boys get in at the bottom of the curve, and when it gets up to a certain level, they don't wait for it to go to the top. They sell and they get out. Okay, they don't wait for it to go way up there. They get out. All right. And so it was with these CDOs, these collateralized debt obligations. And when I'm talking about America, I am talking about millions upon millions of houses. I'm talking about these things were put in place because, number one, the whole idea had sounded correct. It read well. And of course it was put together by psychologists, not only by economists. Psychologists worded this. So it was all very plausible and all very wordable and all like a hypnotic thing almost. And then, of course, they got their buddies, the ratings agencies, Fitch's and Standard and Poor's. They all got all the big backhanders to give these all AAA ratings. knowing full well, all these serious economists know, this is all a game we're in. This is a game. I keep telling people this, and they look at me like they look at you like you've two heads. Do you think the world just existed when the day you were born? The world has been here for thousands of years. Go out and read its history. It has a financial history. All markets go up, all markets go down, all markets stay the same. They're the fundamental laws of markets. I didn't make them up. I just observe them. Now, how if I'm an ordinary man with I don't have any honours degrees in economics or whatever, if I can make these just casual observations, how can all the good and the mighty and all all the smart people, how can they not come to terms with that? How can they not deal with that situation? So what we have is, throughout the world today, this is what's talked about on YouTube, and I have no doubt that it's the case. We don't have billions or trillions. We have got quadrillions of dollars and euros tied up in these things. There are thousands of banks all throughout the Western world today who are, if you did a mark to market, if you took these bits of paper like they have, and that's what they are, they're like this thing here. They're worthless. They're not worth a light. You couldn't trade them. If you say, for instance, 5 years ago, just say you bought these things for 100 units, you would be lucky to take it. 20 units for them or less. There's no market for CDOs anymore. Nobody will trade in them. They don't want them. They know the liabilities. And the other thing that they've done with a lot of these CDOs, they've leveraged them up. Now, I don't want to go into that, but use your imagination. Thousands and thousands of banks, investment funds, hedge funds and pension funds all throughout the Western world are today insolvent / bankrupt. That is a reality. That's why those banks are going to the wall outside Philadelphia. That's why 147 banks this year have gone to the wall in the United States. Because the auditors who are appointed by the government won't sign off on them. They want to, but they can't. They want to sign off on them, but they can't. Because it means that the state will have to do an Irish trick. We already own our 2 leading banks, and very shortly it looks like we're going to own our 3rd bank, Bank of Ireland. They had to go to the bond market this week to raise $750 million. Anyway, this is all getting very, very messy. It's arriving at a crisis, and it's accelerating. It's like falling off a cliff. All the talking has stopped, and we've arrived at the very cliff edge, and we're doing that business. There's where we're at. That's where we're at now. All the cracks are starting to show. And it just takes one, as I said before, just one big country. So far it's all been tiny countries, Greece, Ireland, Portugal. Just one big country to do the default. Just one. Either in Europe or in America or wherever, or state in America. Just one on. To come unstuck. And it's like a deck of cards. They're all tied into one another. People don't understand. They're all tied into one another. So I hate to be the prophet of doom. I don't want to be that way. But none of this is of my making. I didn't sell collateralized debt obligations to anybody. I didn't get involved in raising mortgages or selling mortgages or doing anything else. This is a game. I told you, this is a game for the elites. And I tell you this game is going very, very wrong very, very quickly for these same people. I'm going to have to talk more about this, but that's what's happening in America. So don't forget, you had the monetary instruments at the top, the mortgage-backed securities, then you had to put them into big tranches, and then they were all sliced up into CDOs and sold all around the world. And these are toxic bits of paper, and they're not worth the paper that they're written on, literally. They're like fiat bits, they're really like fiat currency. They're essentially worthless. And it's that's coming home to roost now. And that's what we have to deal with in the immediate future. Anyway, listen, we're going to talk more. Okay. Good luck. Bye.